Good morning. Lots to talk about today. I've had several questions about the bond prices, fixed mortgage rates, what's going on, what to expect. The US inflation data came out. Alberta is bracing for impact. And unfortunately, Honda is pausing an EV plant here in Canada. Let me kick it all off with this. The US inflation rate for April came in at 2.3%. Let me be clear. That was the expectation. It's only a surprise to people who aren't following this. They're like, well, shouldn't the tariffs have made inflation go up? Yeah, the tariffs did make the inflation go up. But oil prices collapsed. That brought the inflation down. So it balances out at 2.3%. Next week, we get our inflation report, and that's why I'm expecting us to be around, well, essentially 1% less than the US. Also, in a couple weeks, at the end of the month, this is going to get updated, measuring the natural rate of interest from the Fed. That will give a new measure for Q1 of 2025. Just as a refresher, Q4 of 2024 ended up there. Canada's natural rate of interest is 1.78%. That's why I say we need to get down below 2%. But you see the Euro area and the United States, right? They have some issues. This is waiting in the wings. The federal funds rate is over 4%, but the natural rate of interest is below 1%. That's a problem brewing. That brings me to bonds and mortgage rates. I think too often people are looking at the bond market too myopically. Like, yes, the mortgage rates are based on the bond prices. And the bond prices have been fairly flat for the last few months. But you have to zoom out. The Bank of Canada has been cutting the rate, and the bond market has been falling at the same time. Now, some people say that the Bank of Canada has to follow this. No, this is the secondary market. These are bonds that have already been issued, now being traded on a secondary market. None of these bonds are coming from the Bank of Canada. The Bank of Canada issues bonds, and then once you have that bond, if you're a corporation or a person, you can trade it. That's what this is. So when people say the bond market is predicting this or predicting that, that's just people guessing what's going to happen. This isn't driving the Bank of Canada. The Bank of Canada is going to make its own decisions regardless of this. And if we zoom out some more, look at the entire history going back to the great financial collapse, every time the rates come down, the bond yields come down as well. That's 2008, 2015, COVID, and now. And we are going to keep cutting. The caveat is this. Don't expect this to happen. This is disaster territory. The sweet spot is right in between 2% and where we are right now. So if you're holding out for a better rate, you can hold out for this to come down a few points. 1% or more, I wouldn't bet on it. Unless things go to shit. All right, a little bit of bad news for Ontario. Honda is pausing their $15 billion EV investment. Why? Because interest rates are high and electric cars are expensive. Or at least Western electric cars are expensive. The cheap Chinese ones are still in China. And then, of course, there's the investment of converting your home to power the car, etc., etc., etc. Anyway, the point is, the EV market is slow. And I think many of these investment decisions were made during the sugar high of the COVID era, when everyone was investing in electric, like it was the next big thing. It is the next big thing, but not quite that big. At least not yet. Honda says they delayed this for a couple years. I do expect them to move forward with it in the future when things settle down. But things are not settling down this year. From oilprice.com, they're talking about the increase in production from the Saudis. So far, the Saudis have unwound about 40% of their production cuts. They've brought almost 1 million barrels per day back onto the market. And the expectation is that they will unwind the rest of that through the summer, which is a problem for shale producers and for the oil sands. Why? Well, even though the break-even points have fallen in recent years, right? So the break-even points are a little lower. Lower-priced oil is still a problem. Danielle Smith is going to help out the Alberta oil companies by freezing the price on carbon. The price on carbon was supposed to increase to about $110 per ton next year, but Danielle Smith has frozen it at $95 per ton, protecting those sweet, sweet oil profits. Because remember, oil is priced on a market. This does not affect the price of oil. It affects the profits. Will this be enough to stave off job losses if OPEC decides to increase production more? Probably not. An end to this trade war would help. Let me wrap it up by saying, again, I am interested to see what our inflation rate is going to be next week. I'm expecting it to be very low. I'm expecting it to be a setup for a rate cut come June.